Today, we're going to discuss about the partnership dissolution. This is a continuation of our video lectures about partnership accounting. Again, this is your course facilitator, Sir Albert Cruz. Partnership dissolution. As mentioned in our previous discussions, the partnership, having a limited life, can be easily dissolved by various ways. Dissolution is the change in relation of the partners caused by any partner being disassociated from the business. Dissolution, however, is different from liquidation. Liquidation is the termination of business operations or the winding up of affairs. Partnership dissolution does not necessarily terminate the business. It will continue until the remaining partners decide to liquidate the business. If the business is continued after dissolution, new articles of partnership should be drawn up. The following are the major considerations in the accounting for partnership dissolutions: admission of a new partner, withdrawal, retirement, or death of a partner, and lastly, incorporation of a partnership. The admission of a new partner or the withdrawal, retirement, or death of an existing partner dissolves the original partnership agreement because it creates a change in the relation of the partners. We will discuss them further one by one. The admission of a new partner may be effected either through the purchase of interest in the partnership or investment in the partnership. It should be noted that the admission of a new partner requires the consent of all the existing partners. A new partner may be admitted when he purchases part or all of the interest of one or more of the existing partners. This is a personal transaction between and among the partners, and thus the difference between the amount to be credited to the new partner's capital account and the amount actually paid will be accounted for as a personal gain or loss. Consideration paid or received by the partners will not be recorded in the books. The only entry to be made in the partnership's books is a transfer within equity. Here's a sample entry related to purchase of interest. To illustrate, let's answer the first problem related to purchase of interest. D was admitted in the ABC partnership by purchasing 10% interest in profits and capital of all existing partners for 80,000 pesos in cash. Right before the admission, partners A, B, and C have the following capital balances respectively: 100,000, 200,000, and 300,000 pesos. All partners are sharing profits and losses in the ratio of 3:3:4 respectively. Question: compute for the capital account balances of all partners after admission of D. So basically, these are the capital balances prior to admission. How do we record the purchase of 10% interest? Or how do we compute the amount to be purchased from these old partners? So that is simply done by multiplying these capital balances of all partners by the 10%. So 100,000, 200,000, 300,000 times 10%, and that will give us 10,000, 20,000, and 30,000 respectively. For the new partner, however, the amount to be credited to the new partner's capital account will be the sum of all of these interest from the old partners, and that is 60,000 pesos. As you can see, the total partnership capital is not affected by purchase of interest. It is because the entry to be made is related to transfer within equity. And now, let's compute the capital balances after admission. So 100,000 minus 10, that is 90,000, 180,000, 270,000, and for the new partner, we have 60,000 pesos. Here's the sample entry, or rather, here is the entry to record the purchase of interest by partner D from the partnership. So that is an example of purchase of interest. Now, instead of purchasing interest from the existing partners, a new partner may be admitted by investing directly into the business. And this is investment in the partnership. This transaction is a transaction between the new partner and the partnership. As such, the consideration paid by the incoming partner is recorded in the partnership's books, unlike in the purchase of interest. Here is a sample entry wherein the amount paid by the new partner is equal to his capital credit. So debit to cash or contribution, credit to the new partner's capital account. In some cases, wherein the amount paid by the new partner is not equal to his capital credit, bonus method will be applied. So in addition to the initial entry discussed previously, bonus will be recorded as follows. So if the amount is greater than the capital credit of a new partner, a bonus to the old partners will be recorded by crediting their respective capital accounts. And if the amount paid is less than the capital credit of a new partner, a bonus to him will be recorded by crediting his capital account and debiting the capital accounts of the old partners. Okay, to illustrate partnership dissolution through partnership admission via investment, let's answer the following problem. So D was admitted in the ABC partnership by investing 200,000 for 20% interest in the partnership capital and profits. Right before the admission, partners A, B, and C have the following capital balances: 100,000, 200,000, and 300,000. All partners are sharing profits and losses in the ratio of 3:4. Requirement: compute for the capital account balances of all partners after admission of D. So to start, let's determine the capital balances prior to admission of D. So for partner A, we have 100,000, partner B 200,000, and partner C 300,000. That's a total of 600,000. Then we account for the investment by D, and that is in the amount of 200,000, equivalent to 20% interest. So that is additional 200,000. As discussed previously, the investment will affect your total partnership capital, unlike in purchase of interest. So this will be your capital balances after the investment. So we have 100,000, 200,000, 300,000, and 200,000 for the new partner, for a total of 800,000. But you have to check whether the agreed capital is equal to the amount actually paid by the partner. So in this particular problem, it is stated that the 200,000 paid is equivalent to the 20% interest in capital and profits. So to check, we have to multiply the total contributed capital of 800,000 by 20%. So that will give us 160,000. So it means the agreed capital of the new partner amounted to 160,000 pesos only. So as you can see, there's a difference. The amount paid is greater than the capital credit. So the difference is accounted for as bonus to the old partners. This bonus of 40,000 will be distributed to the old partners in their profit and loss ratio. So we have 3:3:4. So 40,000 times 30%, okay, that will be 12,000, 12,000, and 40,000 times 40%, that is 16,000 pesos. Of course, when you add all of these three, it will give you the same amount of 40,000. Therefore, it will not affect your total partnership capital because bonus is accounted for as a transfer within equity only. Transfer of capital. So the adjusted capital balances after the investment would be 112, 212, and 316,000. So the total, of course, would still be 800,000. So that's for an investment wherein the amount paid is greater than the capital credit. Now, let's proceed to another problem relating to investment. At this time, the amount paid is less than the capital credit. So same, we have to first determine the capital balances prior to admission of the new partner. Okay, so these are your capital balances prior to admission. So for partner A, again, we have 100,000, 200,000, and 300,000. So that's a total of 600,000. Partner D was admitted by investing 200,000 again. So 200,000 here, and it will affect your total partnership capital. So that will give you 100, 200, and 300,000. Then for the new partner, 200,000 again. So total of 800,000. So this is your balances or capital balances after investment of D. So now, let's check again because this 200,000 is invested for 35% interest in capital profits, in capital and profit. So we have to check whether it is equal to 200,000. So we multiply the total partnership capital by 35%, and that will give us 280,000. So this 280,000 will be the amount to be credited to the new partner. So as you can see, the amount paid is less than the capital credit of this new partner. Again, the difference will be accounted for as a bonus, but this time it's a bonus from the old or existing partners to the new partner. This bonus again will be distributed in the ratio of 3:3:4. There, the old partners P&L ratio. So 80,000 times 30%, 24. So 24, but in this particular problem, it's a deduction because it's a bonus from old partners. 24 again. And then for 40%, so that is 80 times 40%, that is 32,000. So when you add all of these three items, it will be equal to 80,000. And therefore, it will not affect again the total partnership capital. Okay, so the adjusted capital balances after investment of D would be, so this is 76,000, this is 176,000, and then this is 268,000. Of course, for partner D, 280,000 will be credited to his partner capital account, to this partner capital account, and then the total will still be 800,000 pesos. When a partnership is dissolved but not liquidated, a new partnership is created. The assets and liabilities carried over to the new partnership should be restated to fair values. The adjustment to the assets and liabilities is allocated first to the old partners before recording the admission of the new partner, and we call that the revaluation of assets. So in other words, revaluation affects the old partner's capital accounts only. Next, we illustrate the effect of revaluation of assets by answering the following problems. So first, D was admitted in the ABC partnership by purchasing 10% interest in profits and capital of all existing partners for 80,000 pesos cash. Right before the admission, partners A, B, and C have the following capital balances respectively: 100, 200,000, and 300,000. So this is the same as this is the same as our first problem about partnership admission, specifically purchase of interest. The only difference lies on this last statement. 80,000 represents the actual fair market value of the 10% of the partnership net assets, and thus revaluation shall be made accordingly. So in this particular problem, the 80,000 cash will be our basis in determining the actual fair market value of the partnership net assets. So to answer, let's determine again the partnership or the partners' respective capital balances. Okay, capital prior to admission. So 100, 200, and 300,000. Okay, so total of 600,000 pesos. Now, since 80,000 represents the actual fair market value of 10% of the partnership net assets, we have to compute for the actual fair market value of the 100%. So to get this 100%, we simply divide the 80,000 by the 10%. So that will give us 800,000 pesos. So the fair market value of the partnership net assets, 100% of the partnership net assets amounted to 800,000 pesos. So as you can see, there's a difference between the original capital contribution or the capital balances prior to admission in the amount of 200,000 pesos. So this 200,000 pesos represents the revaluation of assets. These revaluation assets, as discussed previously, will affect the old partners' capital accounts only. Okay, and this revaluation, upward revaluation, will be distributed in the 3:3:4 profit and loss ratio. So 200,000 times 30%, that is 60,000. So 60 plus 60, and then 200,000 times 40%. So that is 80,000 pesos. So this will be the adjusted capital balance, but still prior to admission. So 160, 260, and then 380,000. Now, we account for the purchase of 10% interest. So to get the 10% interest from all partners, we simply multiply the respective capital balances by 10%. So that will give us 16,000, 26,000, and then 38,000. Okay. When we add all of these three, 16 plus 26 plus 38, of course, it will give us 80,000. So this is the 10% interest of D, the newly admitted partner. So now, of course, it will not affect anymore the total partnership capital because it is a purchase of interest and accounted for as a transfer within equity only. Finally, so to determine the adjusted capital balances after admission of D, so we just have to determine the net amounts. So this will be 144,000. This will be 234,000. And then lastly, 342,000 pesos. Of course, 80,000 for partner D. So that's how we solve for purchase of interest with effect of revaluation. Next, let's illustrate a problem, okay, related to investment, and again with the effect of revaluation. So D was admitted in the ABC partnership by investing 200,000 for 20% interest in capital and profits. Right before the admission, partners A, B, and C have the following capital balances respectively. So 100, 200, and 300,000 again. All partners are sharing profits and loss in the ratio of 3:4 respectively. So it seems familiar because it is the same problem that we have answered previously, but the difference lies on this last statement. 200,000 represents the actual fair market value of the 200 or of the 20% of the partnership net assets, and thus revaluation shall be made accordingly. Okay, so again, let's compute or let's determine the partners' capital balances prior to admission of D. So capital prior to admission, 100, 200, and 300,000. So here, the total of course is 600,000. Partner D invested 200,000 pesos. So 200,000, this will affect of course your total partnership capital. So the balances after admission amounted to 100, 200, 300, and of course 200 for partner D. So total of 800,000. Now, as noted earlier, this 200,000 represents the 20% of the partnership net assets. So 200,000, 20% divided by 20% to get the 100%. So this is your total partnership capital. 200,000 divided by 20%, that will give us 1 million. So this 1 million is the actual fair market value of the 100% evaluation or partnership net assets. Okay, so again, there is another difference of 200,000, and this pertains to revaluation. Now, same concept. The revaluation, upward or downward revaluation, shall affect the old partners' capital accounts only. So this 200,000 will likewise be distributed to the old partners' capital accounts in the ratio of 3:4. So 200,000 times 30%, that will give us 60. Another 60, and then 200,000 times 40%, 80,000. So the final answers would be 160, 260, and 380,000 respectively. Of course, 200,000 will be for the newly admitted partner. So these are the adjusted capital balances after admission. So in summary, again, revaluation affects the old partner's capital only. Okay. So don't forget about it.